Hey everybody, this is David Skirika. Okay, still, we're going to do a few things here. Still on my website. It's changed. You understand, I'm not using like a professional company. I'm using a guy who's a really good graphic designer and knows a lot about um, internet and the whatnot. But he's like a friend of mine, and yeah, but he actually he's kind of like he was actually like a painter and carpenter and this kind of thing, and he hurt his ankle. He's been out of work for a bit, so I'm giving him some work. But he's really good at what he does, like in terms of this graphic stuff. But we're kind of playing around still. Like we went from GoDaddy to WordPress, and now we're going to use something else called Wix. So please bear with me. I'm hoping that this week, the end of this week, so basically by the middle of the month, this will be up. So this is the website here. Obviously, there's no member section. So we still have no member section. So I'll continue to move this here. Like I'll give the members. You're continuing to get private links to the videos or emails. So, but I am going to get more active this week. A part of the reason is I was doing something called Dollar Hedge Insider. It just didn't work out in the end. These things can happen. Like the performance of the letter was very good because I launched it at the bottom of the gold stocks. We launched it at the bottom of the gold stocks in February, but they just it wasn't really marketed. I couldn't really market it. They couldn't really market it. So we just decided to part our ways. And I know a few of you probably subscribe to it. So either your monthly subscription is now canceled or whatever you have left on your yearly subscription. If you did a yearly subscription, I guess there wasn't that many subscribers on it anyhow, you'll be refunded. Or if you want to join Profit from Pessimism for the rest of your yearly subscription, you can just come over here. You can write me at David at profitfrompessimism.com. So I love this new logo too. Like if you go to my YouTube page, you'll see that's the new logo there instead of me in like a Miami Vice Don Johnson suit. And so I think it's a lot better, a lot more professional. And so it's kind of got the chart going up, and I like the color scheme, the kind of the black and the gold, and because I do so much in gold, obviously that's prudent. So today's stock chart of the day, we're going to be looking at the 20-year bond in Japan. And what's really interesting about the 20-year bond in Japan, I actually just want to do this in my thing as well. So I want to show you the 20-year bond here. Because yeah. So this is really interesting here. So we're going to look at it both on my Twitter page and on here. So what we can see is if we get a max chart, which goes back about 20 years, goes back to about 2005, 2006, right? And you can see we're basically back at the same levels of 2008. And of course, the Japanese debt was a lot lower back then. So this whole thing, we went to almost zero on the 20-year bond. The 10-year bonds did go negative in Japan at that time. And you see we backed up to 2%. And because of Japan's high debt load, they might be the first country to have a sovereign debt crisis. And remember, they were the first country too to do all this quantitative easing, depress interest rates, et cetera, because they were doing all this deficit spending and running huge debts and deficits to kind of prop up their economy after the bust of the real estate market and when their economy really couldn't recover. And what's interesting now is the Chinese 20-year bond is actually lower in yield. We'll just quickly do a Google search on that. China 20-year bond yield right here is actually lower in yield. You can see 2.10 than the Japanese 20-year bond, which as you can see like that we're going to get a monthly chart. You can see this goes back to 2012. This doesn't go back as far, but you can see, it was almost 5% 10 years ago. Now it's 2.10. And as we can see, the 20-year chart in Japan is 231. So this is kind of like two ships passing in the night, or where Japan now is starting to feel the pressure of all this years of overspending, government deficits, using debt to prop up the economy, where China is kind of where Japan was 30 years ago or 35 years ago, and they're kind of entering this kind of deflationary malaise. And you can see the same kind of thing. Like both countries were kind of dependent on a lot of exports, et cetera, et cetera. Both countries had huge real estate bubbles. Both countries had, pretty kind of like centrally planned economies. Even though Japan's considered more capitalist, there's still a lot of red tape in Japan. All the Japanese workers always were known for being taken care of, kind of from cradle to grave kind of thing. So it's kind of interesting. So you can see it here, and you can see this is the chart here, which is interesting. This is the 30-year interest rates as well are now lower in China than they are in Japan. And again, two ships crossing in the night. the Japanese rates you can see since 2018 have gone down, where the Japanese rates or Chinese rates have gone down, and the Japanese rates have gone higher. So my question is, everyone's focused on the tariffs and this being the reason for the sell off, and it looks like we're going to have a recession now in the United States, uh, uh, because of that. And if we go look at sorry, the Atlanta Fed, you're going to see right here. Um, yeah. The economy now is supposed to shrink 2.5%, and this growth was as high as almost 4% in late January. So you can see this here. So obviously the tariffs are playing a major role, and Trump going back and forth on the tariffs and the uncertainty it's causing is playing a major role. But what we can see here, if we get some kind of sovereign debt crisis, this could really, really, really cause something bad to happen. And of course, Japan is still one of the largest economies in the world, a huge manufacturing company, huge card companies, Toyota, Nissan, Mazda, Honda, etc. Right? So and Sony is still a big electronics company. So we can see all of these things in Japan. Maybe that plays a part in as well, because things have a way when they break bad, right? It's not just, oh, the US is going to recession because of tariffs. It's like maybe Japan blows up and has a debt crisis. I don't know. But I do have to say that the sentiment is still quite negative, as I said, and the market keeps dropping every day. But I do believe that we're getting, like, even if the S&P say drops to 5,600, which will break the key support of 57, we are going to get some kind of reflex rally, and that rally would probably be a rally you should be selling. But like again, if we go look at the sentiment indicators, the AAII is three bulls to one, so three bears to one bull, really actually type of levels it usually sees at major market bottoms, etc. So the question I have is this: is just, and I think if the market keeps dropping like this, and the sentiment even gets worse in the short term, I can see Trump just backing off the tariff talk, because I think it's like, when you're at a war, we all talk, if any of you, I'm a big history buff, and about World War I and World War II, or Napoleon. You start fighting on two fronts. You start or you try to overreach. And that's kind of, I think, what Trump is doing right now. It's one thing to do the Doge, do government spending cuts, et cetera, et cetera. But on top of that, because that is anti-growth in the short term, because those government workers lose their jobs. They have nice high paying jobs. So that does take money out of the economy in the short run, even though it's better in the long run to not pay all these bureaucrats. But it is short term recessionary or anti-growth. And then you're also doing these tariffs at the same time. And I think you have to pick and choose one or two of those, right? If you're shrinking the deficit, I think you just have to let trade be as it will right now and not get in all these fights with everyone as well. And then look, there's going to be an offshoot to the trade too. Do you think that people, especially or from these other countries around the world, especially the way Trump talks about them, are going to like want to go out and buy like American products? Like I saw that Ford is doing a $4 billion investment in Germany because their car sales in Europe are very poor. And it's like, well, if Trump slaps tariffs on Europe and starts talking about Europe the way he talks about Canada or Mexico, you think that Europeans are going to want to run out to buy a Ford or GM? Because I'm sorry, they equate those products with America, right? And they're going to be like at this point, I think a lot of these places, like even in Canada, I think if Canada and the US just sat down and say, hey, why don't we have a free trade agreement? Why don't we say no tariffs on anything either way? I think a lot of Canadians, because of what's happened, wouldn't buy US goods, right? And probably some Americans wouldn't buy Canadian goods and vice versa, right? So anyhow, I'll leave it at that. But yeah, today we really wanted to look at the Japanese bond, this huge move higher. And, like these things go on for so long. Japan has been able to keep itself afloat with quantitative easing, with low rates for so long. It's like you always are like, oh, this is never going to happen. We're never going to see a sovereign debt crisis there. But now it looks like something might be closer to happening. So I'm going to leave it at this. I hope everyone's good. Like I said, I'm going to start doing more updates. I'm hoping by the end of the week, this new website will finally be up and running. And then, in about 2 to 3 weeks time, 3 weeks time, actually, from tomorrow, my new book will be coming out. And I think I talked with Newsmax, and it's about the third week. So I think about the 21st or 22nd of April. That's when the marketing will really start on the book. So we'll be looking at doing that, etc. So, but if you want to buy the book, right, On Profit from Pessimism, we do got a link right there. So you can hit it. It goes right to the Amazon thing, and there you go, right? So, and you can see right now they have a 14% um 14% a sale, because the hardcovers, I guess there's only hardcovers right now. So everybody take care. Bye.